What's up, everybody? I wanted to talk to you today about the difference between dividend stocks and growth stocks or compound interest stocks. For me, I personally do not invest in anything that is not a blue chip stock or about to be a blue chip stock. That way, you don't have to worry about the company going out of business anytime soon, and you don't have to worry about any major catastrophes. With dividend stocks, it's a slightly lower risk rate, but also slightly lower return rate as well. Anything over 5%, definitely do your due diligence on. I know there have been some not really scam companies, but scam attempts by various companies to increase the dividend rate to attract investors, and then they go out of business anyway. They lose money anyway. So make sure that the company you're looking into has really good leadership that you like. The company's going in a good direction that you are okay with. And just look into it. Do your research. With dividend stocks, typically you will get a monthly or quarterly. Quarterly is more common. Dividend payment from that. And that is to more so if you want to preserve your money rather than grow it, because you will maintain roughly about the same amount in the company consistently and get those dividend payments, which can act as a source of passive income, but you do have to own a fair amount of stock for that to be profitable. I would say dividend stocks are more beneficial if you're looking at getting in and out of the market in under 10 years, whereas growth stocks, I would say at least 25, 30 years. The payments that you receive from your dividend stocks are not taxed the same as working income, so make sure you understand that on your tax forms and where you're located, because it'll be worded differently in each state, and in a lot of times based on where you file your county taxes will affect that as well. The growth stocks or compound interest stocks, those are the ones that I like for long-term interest rate growth. That's where you can get your compound interest to play in, and that's more so for growing your money rather than preserving it. Because even though, as a trade-off, you don't get the monthly or quarterly payments, but you get continual growth on your stock in the company. So what you initially put in, as long as the company does well, will be a lot more for you to take out at the end, which is why it's also good to leave it in there. The longer the better. When I buy a stock, I don't buy with the intention of ever selling. The stocks that I buy, I intend to hang on to until I die. And it's a mix of dividend and growth stocks. That way I'm increasing my money in part of my portfolio, and I'm also receiving a passive income from part of my portfolio. The growth stocks are a slightly higher risk. Those companies tend to be slightly more volatile, but there's also a much bigger payoff at the end with it being compound interest. And that's another reason why I like blue chip stocks, because if the company never goes out of business and only continues to grow, my money is going to continue to grow as well. So those are a few basic differences and why I choose what I choose. I do a mix of both, depending on your management style and your portfolio, the amount of money you can invest, what your situation is, what your plans are. That'll all affect your portfolio and management style. So if you have any questions or comments, definitely let me know. If you have any other tips or tricks or whatnot, I'm open for that as well. So